Welcome. Today's Monday, March 27th. I'm Jeff Hughes, Chief Investment Officer at JWH Investment Partners and the founder of Alpha Insights. And this is your Daily Five. We're going to start out this morning with just a quick reminder that we are publishing issue number 20 of Huge Insights, the Big Picture, on Saturday, April 1st. So if you haven't subscribed to our investment newsletter, it's free to subscribe to. You can find it on Substack. You can also find it on our website, jwhinvestment.com, or on Twitter at alpha_insights. And feel free to sign up and get the newsletter delivered directly to your email inbox on Saturday morning. It is affectionately titled Huge Insights, the Big Picture. We cover the macro factors in the economy and the markets. And, we give those who are not paid subscribers a pretty good preview of what we're talking about. But if you want to get the full Monty, you do need to upgrade to paid for as little as $10 a month. It includes our monthly market forecast and positioning recommendations. Also, our paid subscribers receive our weekly Alpha Insights Idea Generator Lab publication, which details our top actionable trade idea each week, as well as updated market commentary, and that comes out every Wednesday afternoon. With that, let's jump right into today's slides. Our first chart today is entitled "The Next Shoe to Drop?" ? We picked this little tidbit up from a friend, Charles Henry Monshew, from his LinkedIn publication. He pointed out that small regional banks actually hold about 70% of commercial real estate loans. We did a little additional digging, and we discovered that office properties actually account for roughly 60% of the underlying collateral for more than 3 trillion of these commercial real estate loans that are on the books of small regional banks. Now, according to IBIS World, total U.S. office rental vacancy rates have grown to an average of 17.5% as of December 31st. Now, that is expected to tick down to about 16.9% this year. But if we think about the 17.5%, that's 2.5 percentage points above the 2009 post-Great Financial Crisis peak. So, we would feel like that is something that we should be concerned about. And, the weak fundamentals are pressuring net operating income at a lot of these office properties, which in turn has resulted in an increase in delinquent loans. According to data from TREP, which is a data analytics firm that follows this data very closely, commercial mortgage-backed security delinquency rates for office properties actually jumped 55 basis points month over month in February to an average of 2.38%. We have not seen levels of that magnitude since about 2011. The rate of CMBS loans that have now moved into the workout stage has also climbed by about 60 basis points to 4.43%. That's also very, very high. So, combine these two elements suggest that about 7% of commercial mortgage-backed securities, commercial real estate loans for all practical purposes, are actually delinquent or in a workout stage. And that is a significant proportion. So, these undercurrents of financial stress might actually grow into a wave of commercial real estate loan defaults this year. And that is a serious concern. So let's take a look at the chart on number 2, page 2. The banking crisis is just getting started based on what we've been researching. If we look back between 1980 and 1994, there were more than 1,600 banks that received FDIC assistance, far more than in any other period since the advent of federal deposit insurance in the 1930s. Ultimately, nearly 300 of those institutions were permanently closed back in the mid 80s up until about 1994. And a lot of folks who weren't in the markets back then don't remember the S&L crisis. But this was something that we can kind of look back to for some perspective. And it started slowly with one big bank failing, and it metastasized into a collapse of many, many banks. And, it was determined in studying this that there was really no single cause. It wasn't, this bank had a bad loan book or interest rates went up too much or anything like that. There wasn't even a short list of causes. Rather, it actually resulted from, a concurrence of various forces that worked together to produce, an entire decade of banking crisis. And the lessons that were gleaned from this experience in the 1980s was, number one, that broad national forces, including economic, financial, legislative, and regulatory issues, really established the preconditions for these failures. The second lesson was that a series of severe regional and sectoral recessions actually hit banks in a number of markets. One example would be Texas, where there was, a big focus on oil lending, and we had an energy crisis situation there. And then third, some of these banks in a number of these markets just took excessive risks, and there was insufficient restraint put upon them by supervisory authorities. So, based on all of this, we can say that, it's probably unlikely that this is just one and done or two and done or three and done if we're talking about Credit Suisse. But, the cockroach theory suggests that this is the beginning of a bigger banking crisis that will be broad and take a long time to resolve. And in our humble opinion, the show is really just getting started. So, buyer beware, caveat emptor. Let's look at chart number 3. Chart number 3 really looks at financial stress and how it relates to volatility. They're effectively equal. Some of you might be aware that the St. Louis Fed has an index called the St. Louis Fed Financial Stress Index, and that measures the degree of financial stress in markets based upon a broad array of interest rate changes, yield spreads, and liquidity measures that they follow. And the average value of the index is designed to be 0. That represents normal financial conditions. And so when we see a spike above 0, that represents varying degrees of financial stress. Well, last week, the index hit 1.575. That's a level seen only 4 times during the last 30 years. The first was in 2001 during the tech wreck. The second was in 2008 during the great financial crisis. And the third was actually 2020 during the COVID pandemic. This is the fourth case. And, in each of these cases previously, the VIX actually spiked to a level of at least 45%. And the last 2 of those, the COVID panic and the great financial crisis, we saw the VIX hit 80%. If our concerns about commercial real estate loans and the banking system are valid, then the VIX appears poised for another spike to new highs. I just want to give credit to this chart to Octay Kavrak, who posted this on LinkedIn. Let's take a look at chart number 4. We've been presenting our view on the market using the Elliott Wave principle for some time now. And, some people have commented that, it's absurd to suggest that the market could crash just based on this sort of analysis. And that's one of the reasons we're presenting what could potentially be the catalyst for the trapdoor opening here. Our preferred Elliott Wave count assumes that the January high of the S&P 500, this is January 2022, marked the end of cycle wave 5 of super cycle wave 3. And if that's correct, we've actually been counting 5 waves down into the June 17th low as primary wave 1 of a larger degree motive wave, which we think has the potential to eventually carry the index down to S&P 2250. Now, under this rubric, we've been assuming that the counter trend advance into the August 16th high marked the end of primary wave 2 up, and that primary wave 3 down has been underway since and has been subdividing an intermediate degree of trend, setting the market up for a third of a third wave decline. But in analyzing the S&P's equal weight index, which is the chart on the right-hand side, we actually find a slightly different pattern. We see a leading diagonal. It's not perfect, but it is well-formed, and that bottomed in mid-October on October 13th. And we see this to be an equally compelling count. In both of these counts, the latest counter trend advance, and that being, the primary wave 2 advance, into the February 2nd high, actually retraced 78.6% of the prior motive wave. So if we look at the cap weight index, we're talking about intermediate wave 2, which topped on February 2nd. In the equal weight index, we're talking about primary wave 2, which also topped on February 2nd. Both of those waves retraced 78.6% of the preceding motive wave. Now, based upon the strength of the decline off the February 2nd high that's evident in the equal weight index, we believe that an acceleration of the decline in the cap weight index is probably not far behind. So let's take a look at chart number 5 to get a closer look at this. We're zooming in here to a daily chart that dates back about 7 months to approximately the August 16th high, which is in the cap weight index, the primary wave 2 high. And from that, what we can see is that the decline into the October 13th low was intermediate wave 1 down, and the rally out of that occurred in 3 waves, an A, a B, and a C wave, which terminated on February 2nd at around 41.95 on the S&P. If that's correct, then the 5-wave decline into the March 13th low likely marked the end of minor wave 1 down, of intermediate wave 3 down, of primary wave 3 down. And so this little counter trend advance that we've seen into the March 22nd high looks like it's probably minor wave 2. It probably topped on March 22nd. If it didn't, if we take out that March 22nd high, then this minor wave 2 advance, which is counter trend, might have a little bit more work to do. It could carry up to fill the gap at around 4,090 on the S&P, which is very near a 78.6% retracement. I think that comes in at 4112. So, at this point, unless we take out the March 22nd high, we have to operate under the view that, we are looking at minor wave 3 down here. And that's a 3rd wave decline at 3 degrees of trend. Now, a sustained break below the March 13th low at 38.08 would strongly support the notion that minor wave 3 down is operative, but a break below the December 22nd low would actually confirm that a 1/3 of a 3rd wave decline is indeed underway. The only thing that would break this count would be an advance above 42.30. That would call the whole view into question. But at this point, we see that as a very, very low probability. We think the highest probability is that we will break the December low to confirm a 1/3 of a 3rd wave decline in the S&P. So with that, I want to, first of all, offer you an opportunity to visit with us on our website at jwhinvestment.com. If you've got any questions or want to dig into our work a little further, again, you can find our newsletter on hugeinsights.substack.com. or also follow us on Twitter at alpha_insights. And with that, I want to thank you very much for watching and wish you the best of luck trading today.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.